look at this, and this is where I check the earnings. Okay, we have next week, and it's $1.45. We have the week after. Let's say you get $1.30. We have the next week. Let's say you get $1.40. The point is, how many weeks do we have until the next earnings? So we're in November 22nd. So December 22nd, January 22nd. So in late February, well, I mean, of course we know that, right? But there's going to be like, for 3 months of time, times 4 on average, that's 12 weekly periods. Excuse me, of around $1.30 to $1.45 a week. The April protection costs, what was it, around $3.60? Okay, and so as we go through the weeks, these have fast time decay curves. Fast time decay curves. And you have to realize something too. This is really big. That any premiums we sell for next Friday are going to be smaller because the market does not trade an inkling, a wink on Thursday while we're eating turkey and watching the Cowboys get a victory. And like 2.5 hours on Friday. So basically next week is we have about half, but a little bit more than half of a normal week's premium. So these numbers are all going to be higher in a normal week. So it's unfair to actually write these numbers down where they'll be higher in a normal week, but we'll just do it anyway. Every week. And how many? 1, 2, 3, 4. And for dramatic purposes, I'm just going to write out 12 of these. 1, 2, 3, 4, 5, 6, 7, 8, 9. For you visual people, 10, 11, 12. Look at all these premiums we take in. And the April protection between the end of November here that we're at, between let's just call it December. We're almost in December, which I cannot believe. December to April. How does an option going clear out to April, what's its time decay curve? Well, it's like this. And then it drops off toward the end. It doesn't go up. I mean, it's always going to be decaying, but at a very, very subtle rate for a month or two. And then in the last 6 weeks to a month, it's really going to start dropping off here. So the idea is we have a security blanket. We have insurance etched in stone. We have insurance that you have to own on a car by mandated law in order for you to operate a car. And and it's rock solid insurance, right? If it's a big name, if it's State Farm, if it's Geico, it kicks in. They have laws too that they have to provide, right? So the point is there's ironclad protection that expires at a small rate of decay. Okay, and the idea is, yes, it costs $360, but it doesn't mean that you wake up on Monday and it's automatically at zero. It still exists with its because it lasts clear out into April. And the point is, we can take in week after week after week after week. That's how we get ahead with the money press. That's how we get ahead. And these premiums are going to be bigger in a normal week. We're looking at one of the smallest premium weeks on the calendar because of all day Thursday off and another half or a minuscule day on Friday. Okay, that's how it's answered. So Russ was asking, well, how do you manage the volatility? The real key when you're in money presses is we have to keep watching if we have our edge or not. And most of the times is, yes, the edge is there. We're great. We know when the next earnings date is. We know how things are performing. And the idea is to not plug in too much The idea is to let the week go by and let this time decay factor work in your favor again and again and again. As uh-oh, they're coming to get me. As Sosnoff says, the three truths of life, of course there's death and taxes, and then he says the third one's the time decay of options. And that's what makes this whole thing sing. But you've got to not bring all your stinking thinking and your moods, and you wake up on the wrong side of the bed, and I mean, because the market really doesn't care about really us individually. I mean, it's just going to do its thing. So you kind of have to look in on them, but you almost need to let them work and let them do their thing.